Good afternoon, everyone. Thanks very much for joining me. This is it's an ad hoc webinar. It's the trading plan webinar. My name is Russell Shaw. I'm the FXCM's senior market specialist, and you can see my email address is rshaw@fxcm.com. And today is Friday the 20th of September 2019. Just going to bring up our disclaimers. I'll keep these on screen for a few moments, and then, of course, we will get into the actual presentation. And just while the disclaimers are on screen, I'm going to try and make this webinar as interesting as possible. This is the challenge is as follows. When we do a webinar with analysis and analytics, is very practical, it's very interesting, and it sort of keeps the attention if you get into it. This webinar is actually slightly theoretical. Okay, so the idea of doing a webinar when we're addressing a theory is it's harder to I guess make it as interesting and as interactive as possible. I'm going to try my best. What I want to say is, if there are questions, certainly type those through, and we'll read them out, and everybody will have a say. And the idea here is just to try and keep your attention for as long as possible. The other idea is we are recording it, so if it does happen that you need to revisit this, send me an email, and of course I will email the link out to you. So without further ado, let us go through to our first actual slide. And the question is very topical for this webinar. What is a trading plan? Okay, and the idea here is that when novices come to the markets, and not necessarily trading CFDs and not necessarily trading Forex, but any type of market, be it the stock market, futures market, they come to the market with a lot of energy, a lot of positivity, and a tremendous amount of dreams. And I know this because that's exactly how I approached the market. And of course, when I approached the market, I had no doubt that I was going to be successful. Okay, no doubt I was going to be successful. But the truth of the matter is that without a trading plan, we'll waver. Okay, and we'll develop this with the various slides. We'll waver. What the trading plan effectively is, of course, it's a full set of personal rules and philosophies to trading. It's effectively a roadmap. Okay, now that's very, very important. It's rules, personal rules. Okay, I think that's the key word at the moment. It's meant to be the document that you refer to anytime there is some question that needs to be addressed when it comes to your trading. Your trading plan needs to be so comprehensive that it addresses every situation. Okay, and there has to be an answer to any question that you're going to ask. So even if it comes up that you are it's a completely new situation, for example, and I'm just throwing this out there, remember this is pure as for educational purposes. Let's just say somebody was short oil over the previous weekend. We had that attack on the oil refinery. As soon as the market opens, there is a gap up. Okay, there's a gap up, and the question is, well, what am I to do? What should I do as a trader your trading plan needs to actually have an answer for that. Okay, so just to carry on, I guess, with the points, it provides the structure that you need for to trade. So the word structure, I think, is something that we need to work on as well. So we've got rules. Okay, rules is, I guess, a key word, and structure, I think, is the very important word as well. And it basically provides control in an uncontrollable environment. Okay, now when I actually decided, look, it's time for me to get serious about the market, it's time for me to actually sort of get some sort of education. The one of the articles I read, I can't recall who it was by or exactly where I read it, but the it addressed who were the worst traders when they first come to the market. Who were the worst traders? Okay, that's so the article goes on to say that it is generally professionals, okay, not market professionals, but other professionals from other occupations, be them doctors, perhaps lawyers, perhaps accountants, perhaps engineers. All these professionals are brilliant people, and they have a control in the environment that they operate in. So, for example, a doctor has a certain amount of control, I guess, in the operating theatre, or the lawyer has a certain amount of control within preparing for a matter or a case. There's precedents that he or she can go back and lean on. The accountant follows generally accepted account practice, etc. And generally, the occupation that they have chosen provides some sort of structure. You see that word structure again? It provides them a structure that gives them an element of control and allows them to do their job at a high level. But that is not the case when they come to the market. When they come to the market, okay, that control that they are so used to, well, that's just gone out the window. Okay, the market is going to do what the market is going to do. Now, if somebody decides to buy a particular currency, okay, there's no guarantee it's going to go up. If somebody decides to short gold, there's no guarantee that gold is going to go down. The control is not there. What the trading plan is there to do is to introduce control in an uncontrollable environment. And that's very, very important. It effectively provides the discipline that we lack as individuals, okay? And most importantly, it is the difference between a professional and an amateur. Now, we're going to talk about this in a moment in a little bit more detail, okay? It is the difference between a professional and an amateur. A professional trader knows what he or she must do in any situation. And it all started off with developing a trading plan. It may be that they have entrenched the trading plan to such a degree that they know almost automatically how to react to a situation. But that takes experience, and without that experience, we need a written trading plan. Ultimately, it's going to give us a process which to follow. Okay, so let's just explore this in I guess in a little bit more detail. So I'm going to bring up my trusty drawing tool again, which is Paint, and let's just bring it up. I'm going to relate how I approach the market, and perhaps it will resonate with some of you, perhaps not. But when I got into the market, okay, let's just say I purchased, so I went long. This is just sort of an anecdote, but it's pretty much exactly what happened. I can't remember with which instrument or whatever, but let's just say I went in and I bought an instrument for $10. Okay, that was my entry price. Now, generally, what happens is you pay a spread. Okay, so as soon as you enter a trade, you're at a loss by the spread. Okay, so as a novice, I thought, oh my goodness, I'm in loss. So that put some pressure on me. Okay, next thing I see the price start creeping down. It put some pressure on me. Okay, then it moves back up, and all of a sudden, give a sigh of relief, kind of wipe my brow, and I can see that the position's in profit. Okay, it's now gone up to 10 bucks 50, sort of 10 bucks 75, goes up to 11 bucks. At 11 bucks, I can't stand the pressure anymore. That's where I sold. Okay, took a dollar off a $10 position. Hey, it sounds good. You know, you made 10%. Okay. However, what happens invariably, I found, was that the market move didn't end there. It kind of carried on moving up. It carried on moving up and carried on moving up. Now the problem, of course, was I had sold out at $11. Okay, so yeah, I made a what I thought was a good profit. The problem was that I sold out at 11 bucks when it was now trading, say, at 19. Okay, so although I made a $1 profit, I have actually incurred an opportunity cost there of $8 because I should have had that $8 registering as well. So the discipline wasn't there. I just didn't know when I should get out. Okay, but there's another and there's an even scarier side to this. Okay, so this has also happened to me. I get into a position. Okay, it's $10. Okay, it's $10, and it goes into profit. Okay, and now I'm thinking, well, I've put on a great trade. I'm kind of rubbing my hands together in glee. You know, the idea is that I've gone into profit very, very quickly. Except what happens then is it drops below my entry price. So now instead of having a profit, I'm sitting at $9.80. Okay, and I'm thinking, well, look, 2 minutes ago I was in profit. 2 minutes ago I was in profit. Surely it's going to come back. Okay, the problem is it doesn't. The next thing, it's gone down to $9. So what do? I think, well, it's so oversold now, it has to bounce. Okay, and then I see it bouncing. And I see it bouncing, and I say, yes, I told you I was right. It's bouncing. Except the bounce is short-lived, and it carries on going until it's $8. And it carries on bouncing around, and then it carries on moving. So the idea here, okay, is that I sold too early when I was in profit. When it's going down against me, I'm holding on in hope. Okay, now hope is not a strategy. It's not a trading plan. A written trading plan is what we're after here. Now, let's go through the signs that you need a trading plan. Okay, before I continue, does this resonate with anyone? Give me sort of a yes or a no. I just want to see if anybody's had a similar journey that I've had, because that's generally how I started. So I'm getting a lot of yeses. Exactly. Okay, it's like the beginner circles. It's where we all start, and it's time now to put that behind us. Okay, it's time to put that behind us. I think that these are the warning signs. Okay, so trading on a hunch. Okay, so I think gold is going up. Actually, I heard a news report. There was this reporter who was talking about gold. I think I'm going to buy some gold. Trading on a hunch. Okay, if you're just trading on a hunch, that's probably a sign that we need to develop a trading plan. Okay, this one's a big one. Not taking responsibility for your own trading. Okay, now again, when I was in my early trading days and the market moved against me, there's two people I trade, and one was not a real person. The one person what I blamed was the market, and I used to swear and I used to go, "Oh, that damned market! Look what it's done to me." And the market's got nothing to do with me. The market's going to do whatever it's going to do. It's neutral. Okay, blaming the market, okay, means we don't have a trading plan. Or, okay, a broker phones us. This was big actually with cryptocurrencies. So broker will call up. Go, have you heard of Bitcoin? Yeah, I've heard of Bitcoin. Do you know how good Bitcoin is? No. Trader. Well, it's the best thing since sliced bread. Okay. You'll go, all right, buy me some Bitcoin. Okay. Now, if you happen to buy it when it was just before the run into the end of 2017, all right, well, then you had a fantastic time. Okay, but now the broker phones and it's now trading around about $17,000. He says, you see how easy it is? It's time for you to double up. Add more to your position. Next thing, the last buyer gets sucked in, Bitcoin starts coming down. And who do you blame? You blame the broker. The truth is, it's not the broker's fault. The broker's got a job to do. Okay, the trading plan is your structure. It's going to tell you when you should get in, and it should tell you when you should get out. It's to prevent our emotions getting the better of us. Now, a broker, okay, a broker, an economist. Anyone of nobody can tell you what's going to happen in the future. If somebody phones you up and says, listen, buy gold, okay, it might go up, it might go down, and there could be some fundamental reasons, but realistically, okay, nobody knows what gold's going to be priced at in the future. Okay, it's running a trend. Okay, if it's running a trend, then there's a probability it carries on going. But there's no such thing as a definite when it comes to trading. So again, we refer back to our trading plan. Let me see, trades, turning positions. Okay, what do I mean by this? Trades, turning positions. I think trades, maybe a trade's losing position. Sorry, this slipped past me. Let's just go to the next one. Trading to recover the loss. Trading to recover the loss. So now what happens is we put on a trade. We take a loss. Okay. Let's say the loss is 5% of our trading capital. We want to jump right back into the market and recover that loss as quickly as possible. Okay. So we don't have a trading plan to refer when we should be in, why we should be going in there. All we're doing now is we're trading emotionally. I've made a 5% loss. I need to get my money back. I actually had a guy come into the office. This was a couple of months back, and he had lost 50% of his capital. And I was sitting with him at the table, and I said, well, you're doing something wrong. Okay, if you've done Kubis, revenge trading, exactly. It's revenge trading. I had this guy sitting, he'd lost 50% of his capital. So I said, look, you're doing something wrong. Okay, we've got to change things. I kind of told him what I think needs to be done. He said, Russ, everything you're saying makes sense. I just want to make back my money, and then we'll start adopting it. Okay, so that's what he said. So again, I think we can all sort of, when we removed from that, let's say when we removed from that environment, we can see that it's clearly not the right thing you want to, it's not the right thing to be doing, right? If he's lost 50%, first of all, to get back 50%, you have to make 100% profit. Okay, it's not an easy thing to do, and we're going to talk about that in a moment. Okay, the second thing is, who's to say he's not going to lose another 50% on his remaining trading capital? Just digging yourself deeper and deeper into the hole. Okay, so the trading plan is there to safeguard you. It gives you a structure. Remember, it gives you control in an uncontrollable environment. Okay, so that's a sign. It's a sign to that you need a trading plan. Trades turning position. So Yatin says trade turning positions. In other words, it's called a stop and reverse. Okay, so the euro goes down, you trade it down, then you think it's going to go up, you go straight into that long position. Okay, it's just trying to. I'm not sure if that's what I was referring to, so I apologize. Nevertheless, let's carry on. Jumping between trades. Now, this I've seen often on our webinars. Okay, this is a big one. So I will be talking about something or a pair. Somebody will say, look, I mean, this pair is about to, this pair is moving. Should I do this? Should I do that? And they are, let's give an example. US dollar, Japanese yen is starting to, it looks like it's starting to slow down. So that there's a momentum with US dollar, Japanese yen. Let's assume that a trader is long in US dollar, Japanese yen. So they wanting to, they're wanting the pair to go up. The problem now is that they look at the pair and the momentum has slowed massively. So after a fairly good start, it starts going sideways. Now, as it starts moving sideways, their system or hasn't triggered. Okay, let's say it hasn't triggered an exit, but they see, so US dollar Japanese yen is now losing some steam, but they can see perhaps euro US dollar is starting to pick up. So they'll jump out of the US dollar Japanese trade, go into the euro US dollar without a valid exit signal from the US dollar Japanese yen, which is just taking a breather before it starts its next leg. So there's an ill discipline there. You are not trading any particular system. You are just jumping between trades as you see micro movements. Okay, does that make sense? So jumping between trades without any reason, well, that's probably a sign that you need a trading plan. Okay. All right, so Shadrach, the trade turning positions means when and where the market may turn. Yeah, okay, so we'll talk about that in a moment as well. Let's see Anamite. But it sometimes works against you too. I was up today with pound US dollar, stick to the plan but make much less. Okay, well, is that really true? Is that really true? Okay, let's think about that. I'm going to come back to that, Anamite. It's a very good point you're making. Okay, and Lee suggests trading the turning position, says chasing the market. And that could be right too. Okay, so listen to what Anamite says here. I think it's very, very, now, so so the idea is, should we jump between trades? Should we jump between trades? Well, Anamite, and everybody that's listening, it still comes down to the trading plan. Now, a trading plan may be a high frequency type of trading plan. You might, okay, you might thrive in scalping the market. You might thrive in that, okay, but you would still need rules and regulations to when you should jump across, okay? Because otherwise it is willy-nilly, okay? It's too random, okay? So how do you know how do you know the win percentage of that kind of a trading plan? How do you know what your risk to reward ratio is with that type of plan? Okay, so jumping across from trade to trade willy-nilly, okay, is sometimes okay, is not a plan. That jumping across is going to be part of a it's going to be part of a, I guess, a scalping plan. Does that make sense, Anamite? So when we talk about a trading plan, everybody has very different strengths. And what I mean by that, I'm talking about psychological strengths. For me, trading ultra short term is hair raising. I can't do it with much success. And I'm talking these ultra short term, like in for a couple of minutes, trying to take a few pips out, jumping into the next one, trying to take a few pips out. It's a very stressful way of trading. So psychologically, that type of trading plan is not going to work for me. Okay, but that doesn't mean it doesn't work. Okay, it just means it doesn't work for me. So if somebody has that type of psychologically where they thrive on that type of excitement, then there's nothing wrong with it, as long as it's a trading plan and it's a trusted trading plan. The last sign that you need a trading plan is what we call over trading, is where you actually it's almost an addiction. You can't let the market go. You can't not be in a position. You can't wait for the setups to occur. What you're doing is you think they're going to occur, so you preempt the signal, you jump in, and the signal never materializes. And that's called over trading. You're trading way too much. Now, if you're doing that, that is probably a sign that you need a trading plan. Okay, it's probably a sign that you need a trading plan. Any questions? We're going to go on to the next slide. Any questions, please go ahead and type those through. Okay, next slide. A trading plan is a business plan, okay? And that's because, quite simply, trading is a business. I think we all recognize that. So if trading is a business, then your trading plan is effectively your business plan. And just like a business plan is a living document, so is your trading plan a living document. You may improve on a strategy, okay? You may improve on a strategy, and then you would adapt your trading plan with that type of improvement. It's effectively a document that is consulted regularly, okay? It's consulted regularly. And we're going to come back to this concept in a few slides' time. So having said that, let me throw this out there. What do you reckon needs to be in a trading plan? Let's go ahead. What do you guys reckon needs to be in a trading plan? No right or wrong answers. Just go in there and start throwing them out. Routine. Okay, so I think the routine, exactly. This is a big one. Richard says, why you want to trade? Yeah, why do you want to trade? That is a big one. Your signals to enter and exit. That's from Catherine. Leo, time and day. Yep, exactly. Okay, so are you trading the Asian session? Are you trading the European session? Are you trading the US and the European session? In the time frames you want to trade, 100%. Consultation for fundamentals. Yeah, exactly. So this is what I've got. So all of the ones that you've put in are correct. Okay, so let me go through what I've got down here, and we'll see if we can merge these all together. So the first one I have is what we call risk management. Exactly, Ben, deciding on risk management. Risk management must be part of your trading plan, okay? But there's two parts to risk management. There is money management, okay? And there is stop loss placement. They're two different parts of risk management. Richard has got a good one here as well. Motivation to do it right and cut erosion of capital. Yeah, absolutely. Actions to take if a percentage of capital is lost. Yeah. Okay. So risk management, which includes money management, stop loss placement. Okay, we're going to deal with this in more detail. Entry specifics. So how do I enter a position? Okay. Exit specifics. So these what I've got is my very basic ones. Okay. I like very much what you guys have written here, and I think we'll come back and start including this in the webinar as well. But before we go anywhere with regards to developing the trading plan, before we go anywhere, I want to introduce you to something that I call the first principle. Okay, it's what I call the first principle. First principle is, Mohammed's asked, what is the recommended account size for management? It's a difficult question for me to answer, Mohammed. If I was going to be honest with you, we're talking a few $1,000s, okay? And that's because it allows for adequate risk management. I often see guys come to the market and they are not adequately capitalized. Give a bare minimum. So I'd say a minimum of $2,000. Minimum of $2,000. Okay. And the idea is, if you come, say, with a $50 account, because I have seen that, you actually can't protect yourself adequately. The market moves too quickly. Okay. So the first principle is, okay, what does everyone think the first principle is? I'll just put it up. Preserve your trading capital. Preserve your trading capital. Okay. Preserve your trading. That is the first principle. Okay. If you are looking to build a trading plan, if you're building a trading plan, you've got to build it around the first principle. Preserve your trading capital. Okay. And this is non-negotiable. When ask people what is the first principle of trading, 9 times out of 10, I kid you not, 9 times out of 10 people are saying to make a profit. Okay, that's not the first principle. The first principle is preserve your trading capital. Okay, it's a very different objective to aiming to make a profit. It's a very different objective. Okay, the one is more defensive in nature. Okay, now if I want to make a profit, I can put all of my trading capital into a position hoping to make a profit. Okay, but if it goes against me, I've just done incredible damage to my account. If I build my trading plan around, I've got to preserve my trading capital. Okay, I've got to minimize my losses. Well, then I can get into a position saying, well, I can't put all my trading capital into a position. It's ludicrous. If it goes against me, I'm going to do incredible damage to my account. Okay, so it's non-negotiable. Without capital, so this is what Yatin says, without capital, no more trading. Okay, so you just wipe out your account. And I have wiped out an account in my time. Okay, with no capital, there's no more trading, and with no more trading, okay, there's no profits. So your trading plan must be built around the first principles. Okay, does everybody understand that? Does everyone understand that? It's very important, and I say it in the webinars. Don't be the best trader. Okay, be the best risk manager, and it's in one of these slides as well. Don't be the best trader, be the best risk manager. Okay. Toto, your hand is up. If there's questions, go ahead and ask. If there's a question, go ahead and ask. Alrighty. Now, there's a corollary of the first principle. Okay, so this is another important, and I think I've got another slide saying the same things because it's this important. So this is the corollary. I've heard traders infer that they are prepared to lose X amount. Okay, so I've sat in our boardroom. Somebody has sat across from me, and they say, "Look, Russ, I'm willing to give trading a go. I put in $3,000. Okay, I'm prepared to lose $3,000. That's what they've said to me. I'll give trading a go. I've got $3,000. I'm prepared to sort of lose my three. Well, that's complete incorrect thinking. Complete incorrect thinking. It's going right against the first principle. If the guy or the girl has $3,000, okay, you preserve it. You fight tooth and nail to preserve your trading capital. This is a business. It's not gambling. Okay, if you want to gamble, go to the casino. You'll have more fun. This is a business, and if we build a trading plan around a business, over time it will become a very lucrative business. Okay. Just to see a few comments coming up here. So Yatin says, I've burned 2 accounts because I did not use correct risk management. Ben says, but you have to be able to afford to lose it though. Yeah, so you don't want to trade with your kid's college fund, Ben. So, you have to come to the markets with clearly money that you are able to speculate with. Okay, but even though you're speculating, you still need to make it a business. Okay, you still need to make it a business. Ben says, if they had one, I wouldn't. Touche. Very, very good. Okay. So if you've come to this business, if you've come to trade and you say, look, I've got some spare cash. I'm going to see if I can make it work on the market. If I lose it, no big deal. That's not the way to come to the market. Okay. The best way to come to the market is with a serious mindset to develop a business. Now, a business doesn't develop overnight as well. You've got to give yourself time. You've got to let compounding work for you. That's the right mindset to come. I've heard other comments around the first principle. Okay, so sometimes I've heard traders say that they've made a profit and now they're trading with the market's money. So let me explain what I mean by that. I come to the market. Let's say I come to the market with $1,000. I'll work it up to $1,500. So I've made a wonderful 50% on my account. I've heard traders say, well, the original $1,000, well, that's mine. Okay, the original $1,000 is mine, so I'm not going to lose that. But the $500, the profit that I've made, that I'm prepared to lose because it's the market's money. No. Okay, that's going against the first principle. The first principle is to preserve your trading capital. That $1,500 or that $500 that has just been made on the account, that's real money. Okay, if you had to close up your account on a 50% gain, you would go out, you would cash out that money, okay, and you'd bank it. Whatever profit you have in your trading account, that deserves to be kept. You fight for that tooth and nail. Okay, so as you start building your trading account, your profit becomes your money. It becomes your money, and it's very, very important because you can't grow a trading account adequately if you keep giving back, if you keep giving the profit back. Okay, you have to earn money on the earnings. Okay, that's the compounding effect. So you fight tooth and nail to keep the profits because that belongs to you. It doesn't belong to the market. Okay, it belongs to you. Does everyone agree with that? Does everyone agree with that? Does everyone understand what I'm saying? Excellent. Okay. So you must defend every penny every penny to the best of your ability. Now, it doesn't mean that you're not going to incur losses. That would be ludicrous. Okay, of course you're going to incur losses, and again, we're going to explore this in slides again. That is okay. Okay, taking losses is a business cost here. Okay, but that's all it is. It's not personal. It's a business cost. You set your trade conditions. You set your trade conditions, and you set your stop loss. And if your stop loss hits, well, that's not personal. That's just the cost of doing business in the market. Okay, but you defend every penny to the best of your ability. And when you take a loss on a stop loss, well, that's a calculated loss. Okay, and that's okay. That's okay, provided that it is part of your trading plan. Okay, it's part of, as long as it's part of your trading plan. So the first thing I want to introduce, guys, is the concept of a trading diary. Okay. I'm just taking a look at the time here. It looks like we're going to go over. Is everyone okay? We at 40 minutes past the hour. We'll probably go longer than the top of the hour. Okay, just to give you a heads up. Alrighty. So the first thing I want to introduce is a trading diary. It sounds laborious, you know, and for me, let me give you I'm going to be sort of flat out honest with you guys. As a kid, I was hyperactive. I was hyperactive as a kid. Okay? I couldn't sit still. Even as an adult, you know, it's sometimes I get like when I'm in the office, sometimes I'll walk around sort of bouncing the stress ball, and I'll go around talking to everybody. It's just it's part of my nature, right? So for me to actually record the trades in the beginning was exceptionally difficult for me. I just it's just for me, my mind's always sort of on the go. But it's worthwhile keeping a trading diary, because it's effectively going to help you develop your system. It's going to help you develop your trading plan, and ultimately it's going to keep you it's going to keep you, I don't want to use the word sane, that's not right. It's going to aid your trading psychology. That's the better way of putting it. Okay, it's going to help you monitor your trading psychology, because remember, right at the beginning, whenever I made a profit, I was cutting those profits too soon. Whenever I was making a loss, I was holding those losses too long. That's not the way to trade. What you've got to do is you've got to let your profits run, and you've got to cut your losses short. Okay, that's the basic idea behind trading. So when you start using a diary, okay, you need to start recording pertinent information. So the information, and this is on every single trade. Okay, I'm being dead serious here. Okay, it's almost like a ledger. Okay, it's like a ledger. It's keeping the control. You've got to say how much risk you've assumed. Now, if you read textbooks on risk management, they talk about something called the 2% rule. Okay, and it will come up. I have got a formula somewhere in these slides. We'll talk about the formula, and there's a calculator on the internet. I'll show you the calculator as well. But you've got to know that the textbooks talk about a 2% risk per trade, or if you're trading, if you've got two trades on, 1% each, so a total of 2%. In my opinion, that's too high. Okay, especially if you're new to trading, then it's way too high. I'm talking about 1%, and even possibly less until you really get confident in your trading plan. Okay, so you want to know on every single trade how much risk you've exposed yourself to. Now, if you're exposing your trading account to a 10% risk, okay, it's a bad thing. I was going to say it's not a good thing. I changed the way I said it to it's a bad thing, because we're going to go through what the mathematics of losses in one of our slides that's up and coming, and you'll see the more that you lose, okay, the more difficult it will be for the trader to actually make it in this business. Now, if you're convinced that this is for you, and this is a business that you want to embark, this is a journey you want to embark on, it's a business you want to build, it's a tremendously rewarding business, okay, but it's tremendously rewarding to the pros. And the pros all have a trading plan, and they know their strengths and they know their weaknesses. And if you don't know your strengths and your weaknesses, the best way to find out what they are is to keep a journal of sorts. Okay, you want to put in your entry price. Okay, so that must be recorded as well. So you've got your risk, your entry price, and of course you're going to have to put in your stop price as well. Now a stop, by the way, is not a mental stop. You don't say, well, if it goes down 20 pips, I'll cut. I'll cut. You know, that doesn't work. It might work once or twice until it doesn't work. A stop is you set the stop when you enter, and you never ever alter it downwards. If you're long, you never alter it downwards, and if you're short, you never alter it upwards. Okay. So you have to put your risk in. You have to put your entry price in. You have to put your stop price in, and you have to put your exit price in. Okay, but that's not good enough. Okay, these four bits of information are actually, if you really downloaded I guess a transaction record or some sort of statement, you can probably work this information out. Your trading diary has got to include the reason that you entered. Okay, the reason. Now that's important because it might be a deviation from your trading plan. It can help you improve your trading plan, or it could help you see if you've made an emotional trade. Okay, and you've got to be honest with yourself here. So let's go back to the oil market. There was a massive spike on Monday. Let's just say somebody went long. Okay, now the idea is that if I recall, the oil market was actually looking fairly bearish before the weekend. Then on the weekend, we had the escalation, and then on Monday there was this massive gap up. Now, if you managed to, if you went long, okay, now if you went long, let's say on the Friday, and you managed to actually make some money because it just by some fluke the conflict in the Mid East escalated, that's got to go into your diary. Okay, you've got to be quite honest about it. And with that, you've also got to put in a reason for your exit. Okay, so when I exited too early, the reason I would have written there, because I was too scared to lose my the R1 I made on my 10. I beg your pardon. I was too scared to lose the $1 on my $10. Meantime, it's now trading at $15, $16, $17. Okay, so the reason there, when I write out, well, I exited because I was afraid. Well, that actually is quite insightful. When I go back, and then you can start debriefing, and you start thinking, well, okay, I can see it's trading at a much higher value now than where I exited. The reason I exited was because of fear. Well, clearly it's something that I've got to work on. Okay, and after you've got all of that, put out a performance rating out of 5. So even if you made big money, let's say that you went long on oil on Friday, but oil was actually in a bear trend. Okay, and on Monday there's this massive gap up, and you make 20% plus the leveraging on that. Okay, it still wouldn't rate highly in terms of out of 5 because you didn't follow your plan. Okay, so give yourself a performance rating and never be hard on yourself. Okay, I mean we all our worst critics. I mean, definitely put too much pressure on ourselves, I think. The whole thing about the trading diary is just to try and make it as objective as possible. It's all about improving your trading, and you don't, and you can do it on a spreadsheet. You can keep it in a Word document, whatever you're comfortable with. Just make sure that, of course, that you can that you've got records. And of course, once you let's just say you get a 4 out of 5, debrief where you missed out that last one. Okay, if you've got a 1 out of 5 and you're still profitable, figure out why you've missed that 4 out of 5. Okay, just does that make sense? It sounds I guess a little bit it sounds strict, but I promise you it will be one of the most invaluable habits that you adapt. Does that make sense, guys? Okay. Excellent. Let's move on. Okay, the next part is, I think I went, okay, I beg your pardon. Here we go. The next slide coming up now. All right, I'm giving you the ingredients to be a successful trader. Okay. I appreciate it, Yusuf. Yes, that's what I was aiming for. See, and Catherine, this is interesting. Catherine says she has one, but she finds it hard to fill it in. I hear you, because that's me exactly. That's me exactly. Really, discipline is a trader's best friend in all regards. If we're disciplined all round, and we're not always disciplined. I mean, we all tend to do emotional things, and we all tend to make mistakes. But if we can just it's such a useful exercise. And if you have a diary and you read it, you know, at the end of the day or the end of the week or whatever your routine is, because that's what Anna Mart said. She said, get yourselves into a routine. She's 100% correct. You know, part of that routine would be a debrief with your diary. Okay. Let's take a look at the ingredients for success. Now, the ingredients for success, take a look at this. It's going to perhaps be a surprise. The largest area is this blue area, which is psychology. Okay, so for you to be a successful trader, you have to be a master of your own psychology. Okay, the actual figure there, okay, because this comes off a spreadsheet, the actual figure there is 70% of your success is going to come from your psychology. And it exactly comes down to that first example I showed you. The reason that I was selling out too soon in profit, and the reason I was holding onto my losses too long, was directly because of my trading psychology. Directly because of my trading psychology. Okay, I'm just reading Dillaro's. We can get a report from Trading Plus. Okay, and extra documentation will help. Mohammed says psychology only comes with experience and exposure. Am I right? Yes, I think it is. But the whole point of the trading plan there, Mohammed, is to help get that experience. And whilst the psychology is perhaps not that easy to grasp, the rules in the trading plan should be, and that should be there should be a direct link in my opinion, between the trading plan and almost an immediate improvement in your trading, because your psychology doesn't have much room to waver. Okay, so the 70% is almost automatically improved when you have a trading plan to draw inspiration from. Now, so that's 70%. Okay, by the way, Mohammed, does that answer your question? The 70% is the blue part. This orange part here, well, that's money management. That's money management, okay? So if you want to be, according to this pie chart, if you didn't have any method, okay, if you just use psychology and money management and just traded on a random basis, theoretically, according to this chart, you should be successful. Now, I'm not advocating for that. I'm not advocating for that in the least, okay? You've got to have the last 10%, which is a method, okay? The difference, what I'm trying to say is that when I have a workshop, okay, when I talk about the method, I have every single person taking notes, every single person sitting there, eyes wide open, and everybody's super interested. The problem is that method is only 10% of the trader's success, but that's the part everybody's so excited about. Then I start talking about psychology and money management, okay? And everybody just can't, you see it. I'm not even, everybody's eyes just glaze over. You see it almost immediately, okay? It's almost is, nah, I don't need that. As long as I've got the method, then I'm going to be successful. But this pie chart, incidentally, okay, comes from a chap by the name of Van Tharp. It comes out of a book called Trade Your Way to Financial Freedom, okay, and it's on page 10, I believe, in the first edition. Somewhere on my bookshelf, I've got the first edition. I think it's in its second or third now. Now, the idea is, okay, Van Tharp is a doctor in psychology, and his specialty is in training traders. Okay, so he is a very reputable person, and so this pie chart comes straight from his research. But you see it immediately when I talk about money management. Guys, don't risk more than 2%. That's what everybody says, and I even say only 1%. There's just people just their eyes just glaze, you know, and it's amazing to see. Then I say, and it's quite a thing for me. It's a challenge for me because I really want to give people honest and real information. So the way that we generally work at in our office here is we have a beginner's workshop at the beginning of the month. And we have I have my tutorial workshop, which that's when we can't do our webinars, sort of in the middle of the month, and then towards the end of the month, I have a more advanced sort of workshop. And when I'm speaking to the new guys in the beginning of the month, it's all about methodology. All about methodology. As soon as I start talking about the money management or the psychology, it's almost as if it's esoteric, and phones come out, so they start sort of scrolling through their phone, WhatsApps. If I start talking about method, phone's back in the pocket. Let me start getting the bars and the sells. So it's very, very interesting. Everybody goes through it. It's exactly how I was. But I've been in the industry for many years. I know where the beginner is, and I know where they've got to get to. But it's very hard to kind of communicate that to the beginner. So this chart is super important. Let's go through some comments here. Okay, bear with me a moment. There's a lot of comments here. Okay, so give me the name of the book again. It's called Trade Your Way to Financial Freedom. Trade Your Way to Financial Freedom by a chap by the name of Van Tharp. Let me just see if I can even bring it up on Amazon. Bear with me. Sorry guys, I won't be a moment. I'm just bringing it up on Amazon, and I'm sure this is Amazon.com, but you'll get it on Amazon.co.uk as well. And you can see it's this one. So I've got, this is the old one, and here's the new one, Trade Your Way to Financial Van Tharp. Okay, Trade Your Way to Financial Freedom. Okay. Whilst we're here, I think I'm going to show you one more book. I wasn't planning to, but I think it's tremendously important. It's called Trading in the Zone. It's actually, I found it a very difficult book to read when I first read it. Trading in the Zone. So unfortunately, Mark Douglas he's no longer with us. Okay, but this Trading in the Zone is a book second to none when it comes to trading psychology. Superb, absolutely superb. Okay, let's just see a few more comments here. Yusuf, did you get the name there? Lee Van Tharp's books are brilliant. Yeah. Catherine, that 70% is one of the hardest parts to master. It is the hardest. It's the most important. Okay. So your psychology is what's going to ultimately determine your success as a trader. Let's see. Yatin, trading and diary will help your psychology and tells if your business is on the right track. Highlights where you need to improve as well as more of what works. 100% agree with that. Anamart, if you use your position calculator, what do you use on stop losses in pips? How do you approach this? Different Anamart, we're going to address that. We'll address that. If I haven't addressed it by the end, just ask the question again. But I think we are going to cover that. Okay, Yusuf's got the book. Okay, Ben says it's on Amazon UK for £19. Alrighty. Okay, excellent. Let's just bring this up. Okay, so everyone is, it's now at the top of the hour. I'm going to continue. I apologize that we're going further. We've still got a lot to do. But again, I want to reiterate, this is being recorded. So we're going to go through to our next slide, and this is introspection. And Richard introduced a fascinating question. Fascinating question. When I said, what has to be in your trading plan? Okay. Why do you want to trade? Okay, now it's a deep question, and sort of when I put out the slides, I almost hesitated because you know, it's like, well, I want to trade because I want to make money. You know, I mean, that's what drew me to the markets. Why do you want to trade? It's because I want to become sort of super rich. Like, why do you want to trade? You know, and you really got to get to the bottom of that, because if you're looking to get gains off of the markets, okay, what's stopping you from putting your funds with a asset manager? Okay, there has to be some benefit to the way to why you've come to the markets to trade. Okay, Yatin says that should be your first statement in the trading plan. Yes, you've got to introspect, okay, because it leads to a troubling further question. Okay, comes to there's a troubling further question, because I want to trade because I really want to try and grow my wealth. Well, okay, I hear you. I really hear you. But let me ask this. How proficient are you as a trader? Okay, now this, we have to actually address it. They're tough questions. Now, this is a skill that is learnable. I know it's learnable because there was this group of traders in the past, in the 80s. They were called the Turtles. I'm sure some of you may have heard about the Turtles. Now, the person responsible for the Turtles was a chap by the name of Richard Dennis. So Richard Dennis, who himself was a successful trader, he and his partner had a bet. Can traders be trained, or are they natural? And Richard Dennis says, well, they can be trained. Okay, and his partner says, well, they can't. You've got to be unnatural. And Richard Dennis put in an advert in a newspaper, and the advert was in the classifieds, and it was a tiny, tiny classified looking for people to train trading. And anyways, they became a tremendously successful bunch of traders, and they called the Turtles. And the reason they called the Turtles, I think the bet was made in a turtle farm in Thailand. I think that's how the story goes. So, but the point is, on a scale of 1 to 10, be realistic. Okay, how proficient are you as a trader? And if you are feeling that there is room for improvement, that's fine. There's nothing wrong with that. But you've got to make the effort to improve yourself and become proficient as a trader. Because if this is the business you want, then you have to be a trader. Now, think about it this way. If I wanted to be a physiotherapist, I know, and I'm not, I can't. It's impossible. I haven't been trained up. I haven't been trained up. You know, same thing with trading. You've got to give yourself the training. Okay, it's like any other profession out there. Does everybody understand that? Very, very important. There's lots of resources. There's another book, The New Trading for a Living. It's another book. It's a very good book, The New Trading for a Living, by a guy, Dr. Alexander Elder. Okay, talks about it. So let's carry on. Do you guys know who you're actually competing against? I don't want to scare anyone, but this is just why you've got to get yourself up to speed. Okay, do you know who you're competing against in the markets? Okay, so let's just see, Lee. Why is it then that only 2 to 5% of traders are successful, even those that spend their time learning? Well, I can tell you now, it's because they're failing in their psychology, because psychology is 70% of your success. So that means that they're blowing out accounts on one trade, okay? And that's because trading is the hardest easy money you're ever going to make, okay? It's the hardest easy money you're ever going to make. So you really have to get that part of it handled, and then you'll fall into the part of traders that are successful. Okay, so let me tell you who you're competing against. Does everybody know who this person is? Okay. Does everybody know who that person is? Okay. Catherine, you don't know who this person is? Does anybody know who this person is? Mohammed, Messi, Lionel Messi. Okay, exactly. Lionel Messi. Okay. So this is the question I've got for you guys. Okay, listen very, very carefully, and it's going to sound tongue in cheek, but just bear with me for a moment. If I had to play soccer one-on-one against Messi, I had to play soccer one-on-one against the guy. All right, who's going to win? Who's going to win? Just putting it out there. Yusuf says Messi. Yatin says not me. Catherine says, I guess him. Yeah, okay. Messi if you're not Ronaldo. Okay, so let me change the question. Let me change the question. If Messi says he's going to play at he's only going to put in 50% effort. Messi says he'll put in 50% effort. I say that I'm going to put in 100% effort. Who's going to win? Hey Christian, how's it going, man? So Messi's playing at 50%. I'm playing at 100%. Who's going to win on a one-on-one? Everyone still says Messi. Catherine says, have I got two left feet? Well, even if I don't have two left feet, I still think that he'd run circles around me. But the point is this, okay? You are up against the Messis of the financial market. That's really who you're up against. Not to get kind of make you nervous or scared, but it's more just to say why you have to get proficient in this stuff. Okay, that's because the big banks are employing MBAs, they're employing PhDs, they're employing CFAs. They have got graduate programs where they're actually training guys in-house, and the only thing they have to do for the bank is they have to take your money. That's the only thing they've got to do. Okay. And if they do that, they get a bonus. And if they don't do that, they get fired. Okay. So those are the guys that we as a whole, we are up against these guys. Okay. So the trading plan goes a long way actually to equaling the field. Now, it's such a bizarre statement to make that. It's a bizarre statement. But the reason that these guys are running circles around you as well is because of banks enforce a methodology, a trading psychology. There's not much room to waver, okay? I mean, there are the odd scandals out there. I mean, has anyone heard of Nick Leeson? Has anyone heard of Nick Leeson? Okay, so Nick Leeson brought the Queen's Bank to its knees. That's what he's famous for. Okay, but it's not. It's really not the. It's not the norm. Okay, when you've got a trading plan and a trading journal, all of a sudden you have got an automatic audit procedure that professional traders have forced upon them. Okay, and you've automatically start equalizing the field. So Lee says, well, why do so many guys fail? It's because they don't have that mechanism to control their emotions. Okay. Incidentally, do you know how Nick Leeson? Do you know how Barings Bank failed? Do you know what Nick Leeson was doing? Does anybody know? Total says options trading. It was actually futures trading. What he was doing, he was hiding his accounts. Yeah, he was hiding his accounts until he wasn't. But what he was doing is he was going long the Nikkei. Okay, he was going long Nikkei futures. Okay, and every time it moved against him, he kept doubling up. Okay, until he had a ludicrous position. But at all times, he was trying to go long the Nikkei. The problem is that if you looked at the trend, if you were a simple trend follower, you would have clearly seen that the Nikkei on a long-term basis was trending down. Okay, exactly. Richard says he was compounding his losses. He was averaging down. Eventually, Barings Bank went bust. It was bought out by ING. Okay. Right. We're going to get into a little bit of mathematics now. Is everybody with me? Is everybody with me? We're getting on to the fun stuff. Okay, excellent. What we want to look at is we want to look at sort of our distribution of trades. Okay, now this is what we call a normal distribution curve, and I've actually been having a discussion with a colleague of mine, a brilliant guy, and he says, well, the distributions in the market are not quite normal distributions, and there's a statistician named Sherbyshev who's done some work. Forget about it. Okay, for this particular webinar, just look at the distribution as a normal distribution. I promise you it's going to make sense to you. Okay, and just as an aside, Richard does say, and British taxpayers bought out ING's losses by buying parent bank RBS, okay, which is the Royal Bank of Scotland, I believe. Is that right, Richard? Okay, so now let's just look at this distribution curve, because we use it a lot in our webinars, but it's super, super important. Now, what we have here in the middle, okay, is our break-even point. So this break-even point here is sort of the center line, and then you can see that there is 34% to the left, 34% to the right, and that takes us up to what we call the first standard deviation, which is a measure of volatility. But what the normal distribution curve is saying is that 34% of your trades are going to be within the standard deviation to the left of break even, and 34% of your trades are going to be to the right of break even. Now, clearly, if they're to the right of break even, you're making money, and if they are to the left of break even, you're making losses. Okay. Now, to be fair, if you are trading 34% to the right, you're not going to be getting rich anytime soon. Okay, and if you are trading in the 34% to the left, it's not going to break your trading account. Effectively, what happens is the small losses and small profits tend to net off with each other. Okay, but besides that, so 68% of the time you're going to have sort of, I call them nothing trades. They're not nothing trades, it's just a matter of statistics. But 13.5% of the time, you actually make some really decent profit. You're trading now between the first standard deviation and the second standard deviation. And that 13.5% is actually a fair amount of pips, it builds your trading account quite nicely. But at the same time, 13.5% of the time, you're going to be making some heavy losses. Okay, just bear with me here. Okay, so 68% of the time, nothing trades, they net off. 13.5% of the time, you're going to make some good profits. 13.5% of the time, you're going to make some bad losses. 2.35% of the time, you're going to make superb profits. It's going to make your quarter. It's going to make your half year. Okay, but 2.35% of the time, you're going to be trading over the second standard deviation to the left. It's going to ruin you as a trader. So then the question is, well, Russ, you're telling me that if we get to the left tail, the tail risk, I'm going to be ruined. I'm not saying that. I'm saying that if you leave trading up to mathematics, that's what's probably going to happen. Okay. Now I'm going to go to the next slide, and we're going to revisit this bell curve in 2 slides time. But this is a very important part of trading. So the idea is, while it's okay to have a small loss, it's not okay to have a big loss. Okay, because the small losses, if you make like a 5%, 10% kind of over time, not in one go, over time, because you might have, let's say, 4 or 5 losing trades in a row. Okay, I know a trader that had 8 in a row, and he was one of the best traders I know. And the idea is, you know, they're okay, because when your system reverts back to profitability, they kind of net off. But when you start getting past the first standard deviation, okay, it gets very, very difficult to actually come back to break even. And that's the cruelty of the mathematics of trading. Okay, the mathematics of losses are terrible. It's diabolical, and it can ruin you as a trader. Take a look at, I've actually charted the losses versus the percentage to break even. What it's saying is, If you lose 5%, you need to make 5.3% to break even. If you lose 10%, you need to make 11.10% just to break even. And that's okay. But when you start getting to 30%, and then you have to make 42% to break even. When you get to 50%, you need 100% just to break even. It becomes impossible. So the problem with losses is that they increase on what we call an arithmetic scale, but to break even increases on an exponential scale to the point that it becomes impossible to come back. So if we go back to this chart over here, okay, as soon as you start getting past the first standard deviation on the left, you're in serious trouble, okay, because of this chart over here. Does that make sense? Okay, I'm gonna give you the solution in a moment, but does that make sense the way I've explained it? Okay, so Catherine says kinda. So let's go back, Catherine. Let's say you've got $100, right? You lose 10% on the $100. That means you've got $90 left in your account. You make 10% now, okay? But 10% of your remaining capital, only 10% of 90 is only $9. So even after you've made 10% after your 10% loss, you're still $1 short. Does that make sense? And the more you lose, the worse it becomes. Okay, so when you start getting, if you've lost 50%, so you've got $100, it goes down by 50%, all of a sudden you're sitting with $50. Well, how do you get back to $100? You've got to make 100% on that. It's close to impossible. Lee, what percentage loss would the 34% deviation be equivalent to? Well, I can't give you the exact number. I'll have to work it out, but it would be perhaps around 50% or so. I mean, it's heavy. It's heavy. Okay. Let's go back to the. So how do we deal with that? How do we deal with that? Okay. Well, there's only one way. Bang. You've got to cut off the left tail. There's no other way to do it. Okay. And the only way you can cut off the left tail is using a stop loss and risk management, and by never ever losing more than the first standard deviation. Okay, so the idea is that you are changing a normal distribution. All of a sudden, it becomes what we call a positive distribution curve because it doesn't have a left tail. And as soon as you've got a positive distribution curve, well, then you've got a positive system, a positive expectancy system. It means over the long term, the mathematics say you have to be making money on your account. It's only going to work if you're using a stop loss and risk management. Otherwise, it's not going to work. And we've discussed this before. And the business that does this the best, okay, I often say, which is the business that does this the best? It's the casino. The casino does it the best. The casino knows it's going to pay out big, but it only pays out big once in a while. Okay, it's a positive expectancy system. Time and again, you can bet your bottom dollar that the casino is going to come out on top. Okay, it's working a positive expectancy system, which is a positive distribution curve, and we as traders have the power to do that. All we've got to do is use stop losses and risk management. Does that make sense? Okay. So the mathematics support the psychology. So that's the problem, okay, is that when your psychology fails, the mathematics is going to start acting against you. And you've just seen how detrimental the mathematics of losses are. So that's why, Lee, we're talking about only a few percent of traders making it. It's because the mathematics are against them because they don't respect the mathematics of losses. Everybody with me? We're about to sort of move on to the, I think the final part. Okay. So all of this information has to go into the trading plan that you are adopting. Hang on, Yusuf, we're not quite done. We're not quite done, but this all has to go into your trading plan. I wanted to talk to you about what we call top-down analysis. Okay, top-down analysis. Okay, excellent. Top-down analysis means that we want to look at the big picture. Once we've got the big picture, we can go down into the smaller picture. Okay, and we trade generally on the smaller time frames. That's the space we generally play in, and it's not a hard rule, of course. But the idea is you want to know what the bigger trend is. You want to know what the bigger trend is, because let me bring up my drawing tool again. And the idea is we know that we're going to have a bull market, okay, and we're going to have a bear market. Okay, those are bear markets. Those are the primary trends. But the market doesn't go up in a straight line. It's moving up in that zigzag, fashion. Okay, and in the bear market, okay, it's the opposite. It's still zigzags, but the zigzags are sort of opposite. So what I mean opposite, if you can see, we've got here what we call the impulse moves. Those are the movements up in the same direction as the primary trend. The impulse moves are the more powerful. They're the more powerful of the I guess the way the market zigs and zags, right? So the idea here is we want to know we want to work from the top down. We want to know where is the actual direction. Once we get an idea of where the actual direction is, okay, we're in a tremendous position. Okay, so we want to. So the question, and this has to go into your trading plan. Okay, it has to go into your trading plan. Okay, so Lee says, in his experience, even with good psychology and money management, it's very difficult to be profitable. It's very difficult to be profitable. Okay, if you want to expand on that, Lee, I'll be very, very interested to know sort of further thoughts on that. But that's what you've stated. Very, very interesting. Okay. The idea is we want to identify the primary trend. We want to identify the primary trend, and one of the ways we can do this is peak and trough analysis. One of the ways, okay, but it must be in your trading plan how you're going to do it. Okay, we'll do some examples in a moment. Once we know the primary trend, you've got to know what is your preferred direction. So, and again, it goes into your trading plan. Do you want to trade the impulse moves, or do you want to trade the corrections? Now, my personal preference is to trade in the direction of the primary trend. Some prefer to look for overbought signals on the impulses and try and fade the primary trend. Okay, they both can work, but I find that for me, it works better if I'm trading in the direction of the primary trend. Okay. And we want to know what the underlying fundamentals are. We want to know what the underlying fundamentals. So if we can get the primary trend, it should be reflecting what's going on with the underlying fundamentals. So I've got as an example here the S&P 500. Now I've gone all the way back to 2008. Okay, so this is the global financial crisis. So you can see if we had to do peak and trough analysis, it's much easier in hindsight. I fully understand that, but just to give you an idea of what I'm talking about. Okay, so you can see sort of from 2003. The market tended to be showing very strong impulse moves up, very slow corrections, okay, or very soft corrections, perhaps the better way to put it. Kind of moves up there, kind of there, okay, and then here, and then here, and then it's just a waterfall effect, okay. Now, if we understand that peaks and troughs, okay, if we understand that peaks and troughs define trends, then we must understand that higher troughs followed by higher peaks is an uptrend. So, well, over here, now this is a monthly chart. The idea that something was wrong was probably there, and I agree. In hindsight, it's much easier. Okay. And if that wasn't the case, then over here was certainly a second time to exit and potentially miss most of the fall down. So the idea is you have to know what the primary trend is, and then understand what's happening on the underlying. Okay, so peak and trough analysis is one way to do it. The other way that I've shown you guys is, of course, using the I beg your pardon, let's just go S&P 500, is the zone analysis. Now, you know that not one is not better than the other, but you just got to have in your trading plan how you're going to identify the underlyings. And once you've got the underlyings, okay, you can start trading in the direction of the underlying primary trend. Does that make sense? Okay, does that make sense? Has to come into the trading plan. It's not Elliott wave. Elliott wave is a particular wave count. I'm just going simple here, Mohammed. I'm just talking about normal peak and trough analysis. And the idea here is that if you find it difficult, reading the peaks and troughs, that's okay. You've got to just then find a method that works for you. So, for instance, what happens if we used an EMA system here? So if I add exponential moving averages, I beg you, that's the wrong one. So if I add exponential moving average, and I put in, say, the 5, I generally use the 5. Let's add in the 13, and these aren't magic numbers, okay? It's just when I put it together, it was Fibonacci's, and okay. But what you want is a short, an intermediate, and a longer term. Okay, so let's just say you have trouble with the peaks and troughs, and it's hard on the eye. Okay, it's hard on the eye. But what you can see is you have a fairly bullish movement here when all three are lined up. Okay, but as soon as this happens over here, okay, where they're not lined up anymore, well, this is on a monthly chart. It's perhaps suggesting trouble ahead. So you've just got to have some way of measuring the underlying. Once you've got that, okay, you refer to it all the time in your trading plan. You've got to find out what your preferred direction is and if you understand the underlying fundamentals. And Christian says the 200-day moving average is also used to get the main trend on a daily and a 4-hour chart. So that's what he uses. Okay, that's in his trading plan. And then we want to see if there is an intermediate reaction. Why am I talking about an intermediate reaction? Well, because the intermediate reactions could provide opportunities. Okay, see over there. Those are the intermediate reactions. Yes, well, how do we know when that reaction's over? Okay. Yusuf, I use a 5-13-34. 5-13-34. Is the reaction tradable? Okay. Where do I put my stop? And what is my risk exposure? And how will I exit? Okay, so now everything we've talked about is coming down to the actual trend analysis. So we start off, how do we know the primary trend? What is the preferred direction? What are the underlying fundamentals? Is there a reaction? Okay. Is it tradable? Where do I put my stop? What is my risk exposure? How will I exit? Okay. So the idea here is we're getting fairly close to the end. What I want to suggest to you is that you start writing out, okay, what your setup conditions are. Okay, write in what's going to be your first condition. Write down what's going to be your second condition. Write up what's going to be the third condition, the fourth condition, and even a fifth condition. If you go to 6 conditions, too many. Just make sure you know what your setup conditions are. Okay, that's the first step. And don't trade until you have those setup conditions. Okay. The next thing to start off with is, well, where are you setting your stop? Well, you're going to set your stop generally at support if you're going long. You're going to set it at resistance if you're going short. That should be an if, I beg your pardon. But it's determined by the markets. Okay. And it's very important that we determine the stop. and it would probably be just under support or just over resistance. And we need to know that because that is what you're going to use in your risk calculation. Okay, so Anamart, this comes down to your question. How many pips do you know? Well, it all depends where the last support is or where the last resistance is. Okay, and then you're going to plug it into a trading formula, which is your trading capital times your risk percentage, which should be less than 2%, closer to 1, and probably even less until you have a real trading plan, divided by the pips to the stop. And that is the number of mini lots. So let's just do a working example here, because just looking at the theory is perhaps a little bit too far from where we have to be. So if I bring this over, okay, this is for an example. Let's just say, let's get a bit closer to the action here. Let's go to the 1 hourly. So let's just say I wanted to go short here. Okay, let's just say I was going to go short here. So this is the S&P 500. Probably put my stop over the just above the last resistance. Okay, and that's the amount of points away. You just take your ruler and you measure it. If you go through, say, to the euro, say you wanted to trade short here, you put it over here. And let's assume you went in over here. You measure how far away are you. So here you're 20 pips away. Okay, 20 pips away. If you go through to gold, okay, they're all going down. Okay, put in your stop here. Measure from your position and plug it into your formula. Okay. And Amat says, I also use this. Just thought you might have a different approach. No, it's pretty standard. This is pretty standard stuff. By the way, let me show you a very cool web page. So we looked at Amazon. Baby Pips is it's got nothing to do with FXCM, but it's such a cool website, babypips.com. Okay. And you go here where it says tools. Go click on tools. Go through to position size calculator. Just click on that. And now, if you've got a US dollar account, keep it as that. If you've got a pound account, make it pounds. Let's just say the balance in the account is $1,000. Say we only want to risk 1%. Our stop loss is 20 pips away, and we're trading the euro US dollar. You press calculate, and it tells you exactly how much to trade to calibrate with your account size. So that's on Baby Pips under the position size. It's doing exactly what the formula is telling you to do. Okay. And then you've got to trail it. Okay. We're getting very, very close to the end. I know we've been going now, wow, an hour and a half. Then you've got to know when you want to exit. Are you going to have 3 exits? Are you going to have 1 exit? Or are you going to have 2 exits? In other words, you might exit at the first pivot, 50% of your position. You may enter at your second pivot, another 50%. The last you may use as a trend following. That's all going to be a part of the trading account, a trading plan. Okay, it's exactly what you've got to have for your trading plan. Just the last slide, guys. The last slide. Okay, just remember, there's no such thing as the market's money. Okay, it's always your money, and you always defend every penny. A large loss was once a small loss. Okay, so never incur a large loss. Make sure you're only incurring those small losses. We've seen the mathematics of large losses, and if you look after the losses, the profits will take care of themselves. Okay, that's why don't be the best trader, be the best risk manager. Okay, don't be a good trader, be a good risk manager. And ladies and gentlemen, that takes us to the end. That takes us to the end. Richard, what I'll do is I'll send you a link to the recording. Would that be okay? Awesome. Okay, whoever wants, Okay, whoever wants a recording to this, send me an email. Okay, send the email through to, let me get my email address up. Okay, rshaw@fxcm.com. Just send me, and I will of course send you a link to the recording. Okay, so let me just see if there's any questions that need to be addressed, and then we'll call it a day. Thank you very much, Ben. Thank you very much. I appreciate it. Yes, Richard will certainly send you the slides, or I'll send you the recording. Somehow I don't have in my PC. If you share it with me, Yusuf, just send me an email. I'll send you a link to the recording. Christian says he takes half his profit. I take half profit halfway to my target. Okay, so he splits it into two lots. But it's part of your trading plan, and everybody's trading plan has to be particular to them. And Amat, you suggested that you like going between pairs. That's fine. That's the type of trader you are. Just make sure it's in a very methodical, sensical trading plan. Make sure it's written down so that you're never second guessing. Any other questions before we sign out, guys? Any other questions? Type those through. Thank you so much, Richard. I really appreciate that. That's really appreciate that sentiment. Okay, Mohammed, what are the swing areas? Mohammed, what we'll do? Join me for the US Open. We'll look at some swing areas. Okay. Yeah, so Christian says sometimes retail traders are at a disadvantage because the corporations are using level 2 platforms. Look, there's no doubt about it that the retail trader is at a disadvantage. But having the only solution, Christian, is to have a trading plan written down. Please show the stop loss slide again. The stop loss slide again. Which one was that, Richard? I'm just going to go back. This one? Is that the stop one that you talking about, Richard? Third from Y. Third from Y. Third from. Let me just go back. That one? Oh, okay, you've got it. Okay. Key rules. Key rules. Just the last. There we go. Anamart, I've sent that through to the support guy, so we'll get someone to respond to you. I'll just mention it to George that you're still waiting on that. Do I keep a position on a rollover? Yes, as long as the rollover is in my favor. I generally would do that total. Yeah. Alrighty. Any other questions? Alrighty then, guys. I think it's time for a coffee. So I'm going to end this webinar at this point. We'll do the US Open in about an hour or so. Thank you very much, and looking forward to chatting with you then. Thanks, guys.